Hi, welcome back to another edition of Lippers Fund Flows Insight. My name is Tom Rosine. I'll be reporting flows for the week ended Wednesday, April 15th, 2015. Now, we've seen 3 consecutive weeks of pretty big outflows come at us, and of course they've all been money market funds, this time to the tune of about $34 billion from the conventional fund business. We'll certainly talk about ETFs as we rattle on in this presentation later on. Basically, we're still very nervous as a group to take a look at Q1 earnings reports and learning that the Empire Manufacturing Index came in lower than expected, showing some decline, if you will, in economic growth. And then also we saw GDP numbers in China come down. However, we've also seen on the flip side more mergers and acquisitions going on. So there's been a lot of merger news and liquidation news that have come out that have actually made some of the market pop. But in addition, according to our brothers over at Proprietary Research for Thomson Reuters, basically they've said, hey, of the 40 S&P 500 constituents that have reported so far, 32 have beat expectations. So we really had kind of a tale of two cities. We had people pulling money out, but the markets did pretty well. In fact, the Russell 2000 hit an all-time record high on Wednesday, the 15th. So kind of a head scratcher. Let's see how the macro groups panned out and who lost what and who gained what. Equity funds actually saw about $3.6 billion in outflows. Taxable bond funds were the only plus side to see about $1.6 billion in inflows. Municipal bond funds actually saw about $0.6 billion in outflows. It's a pretty big outflow for them. But the pariah here was money market funds, seeing $31.4 billion go out of their coffers. Now, this is not an unusual event if we take a look at money market funds at a quarter end, especially around tax season. We think a lot of this can be related to tax season or even funding 401ks, IRAs, and other payables by institutional investors. And you'll see later on that the lion's share, the chunk of that outflow was institutional investors, so maybe not anything to be too concerned about. Well, now that we've already got a kind of an outline of what's going on, let's take a look by the macro groups one by one. Let's first take a look at equity funds and see what happened in that group. Equity funds actually saw a plus side return, 1.02%. Third consecutive week we've seen plus side returns, but this is the fourth consecutive week we've seen outflows, and this time to the tune of $3.6 billion. How that panned out is domestic equity funds lost about $4.2 billion, 11th consecutive week that people have been pulling money out of domestic equity funds, but they have been a little bit more adventurous to go into the non-domestic equity funds. We saw about $700 million in inflows, and this is the second consecutive week we've actually seen inflows. If I break that down even further, if we take a look at the large cap funds lost about $2.6 billion, so a lot of people running from the large cap area, but we also saw equity income funds lose money this week, about $800 million, which is a new trend. Usually it's been large cap and mid caps. Now we're including equity income into that group, and I think it's because there is some interest rate fears that are out there. We heard some news from the Fed that basically there were a couple of hawks in the last FOMC minutes that came out and said, hey, listen, we really do think it's time to up the ante and start raising interest rates. I think that concerned people that were looking at equity income and income-oriented products as well. Well, now we take a quick look at international equity funds, and international equity funds actually saw the money come in, so about $0.6 billion or $600 million into their group. And actually, if we take a look at emerging markets, they saw the largest chunk of money come in, about $300 million of the overseas areas. So Pacific Asia, the Pacific region funds, the Japanese funds, and Pacific ex-Japan funds all saw a little bit of money come in. They were all on the plus side. So again, people were adventurous going overseas. Let's see how that panned out also in the equity ETF arena. For the second consecutive week, we've actually seen inflows, about $3.8 billion come into that group. Deutsche MSCI EFA hedge, people don't want to take their currency exposure, but certainly a hedge position in the ETF, so about $1.4 billion of inflows. iShares MSCI emerging market ETF, so about $800 million. And on the very bottom, as we've seen with people trying to get out of the way of the U.S. economy, thinking it's going down a little bit slow, Spider SP 500 lost about $3.2 billion, and then we saw iShares Russell 2K lose about $600 million. Remember what I just said, though, that the Russell 2000 hit an all-new time high. So I don't know that people are chasing performance or not chasing performance. I think they're actually just taking a different track. Maybe they're learning, from our past problems and putting money to work in those non-domestic equity funds. And in fact, if we take a look at non-domestic equity funds, The non-domestic equity funds actually saw the second largest inflows. This is for ETFs now on record. That was, again, a big number to take a look at. And when we take a look at that, obviously investors are very encouraged to go overseas right now. In comparison, I think they've got the value of the dollar is very strong. They can go and buy some of the cheaper overseas issues that have not been run up quite as far as of yet. So take a look now at the fixed income arena. And the fixed income arena basically saw the only good news, about $1.6 billion in net new money coming to their group, 15th consecutive week. They've taken in money. And for the third consecutive week, we've actually seen plus side returns, this time only to about 0.36% return. But again, if we get these little, third percent returns, 0.5% return every week, that does that up over the long haul. Now, we have seen a change in leadership. The flexible income funds actually took in most of the money, about $0.7 billion, 12th consecutive week. They've seen money come into their group. But here's kind of a new entrance. Again, people looking for a little bit more risk on the table. High yield funds, and of course yield. High yield funds took in about $400 million, second consecutive week. They've seen good net new money come into their coffers. But the big story here is corporate investment grade debt funds for the second consecutive week handed back money about $110 million, or $0.11 billion actually in outflows. Let's take a look though how that panned out to ETFs. This was really a ho-hum week for fixed income funds for ETFs. ETFs lost about $22 million. To me, that's about a rounding error. It's the first week in 5 though that they've seen negative outflows. And if we take a look how that broke out, the iShares iBox high yield corporate bond fund ETFs, so about 428 million come in. PowerShares senior loan ETF basically saw about $196 million. That's a change. People are now putting money to work back into loan bar or loan shares, bank loan funds, whatever you want to call them. They're actually taking in money. So people are starting to believe that the FOMC is probably getting closer and closer to raising interest rates. At the bottom of the group, we saw iShares, the mortgage-backed security ETF, lose about 364, and that makes sense. People are shunning now the treasuries in anticipation of probably the Fed raising interest rates, at least for this week. Let's see what happens next week. Let's take a look at muni bond funds now, and that's actually an area that we've been seeing some outflows. Third consecutive week, we've seen money leave their coffers, $613 million this time, and it's the second consecutive week, though, that they've had negative returns, this time to the tune of 0.04%. So really, we haven't been seeing a lot of negative numbers in there, but certainly negative outflows. National muni funds actually lost about $589 million in outflows. So that was quite a big chunk that they saw in outflows this week as well. And it's the third consecutive week that this group has seen outflows after having 32 consecutive weeks of inflows. So a little bit of story there. A lot of times munis will kind of follow and travel along with treasuries, and maybe that's a story. People are just anticipating an interest rate hike on the treasury part of the fixed income universe. Let's take a look now at money market funds, our last group. And for the third consecutive week, we've seen some pretty big outflows, $31.4 billion this time. Again, as I mentioned in the introduction, this could be typical just tax period time. We're right around the April 15th deadline. In fact, the day we closed this down was April 15th. When we start taking a look at the very closing date, people probably still be filing up till that, midnight on the 15th, and certainly, doing extensions after that on the 20th as well. But taxable money market funds actually saw about $26.1 billion in outflow, and how that broke out. As I said before, institutional investors took about $22.4 billion out versus the retail investor took about $3.7 billion out, and then that brings us to the tax-exempt money market funds, which only saw about $5.3 billion. I say only, but actually that's a really big number. I don't think we have seen that much money come out of tax-exempt money market funds for at least the last 7 months. So that's a pretty big chunk to be losing there. Maybe they are also paying taxes as needed. So that brings us to the end of our conversation. And basically, usually I try to finish up with some economic news that might bring something forward for the week ahead. And basically, one of the big news that came out is CPI rose 2% in March, and I think it was lower than expected. A lot of people had anticipated a 3% rise in CPI, but certainly a rise in CPI and rise in almost every category as well. Wages and income and the rest, minor increases, but all had increases across the board. Certainly is suggestive of possible future Fed intervention and interest rate hikes. Well, if I haven't covered the area that you're interested in, you can certainly go to our site at www.lipperusfundflows.com, or join us next week when one of our analysts will talk about the flow trends for that week. Well, thanks for joining me. My name is Tom Rosine, wishing you the best in your wealth planning and creation.